primarily set up to benefit the community as a whole, as opposed to just the physicians, the insiders, and the people managing the hospital. Now, the IRS didn't really say, for this purpose, what is independence. I mean, there's not a really good definition. In fact, in all the stuff you look for out there, there isn't a lot. But, you know, what is clear, they've identified a few people, and that is physicians. Physicians working at the hospital are not considered independent. You know, paid officers, department heads, key employees. But what's interesting for this definition, though, is you can have people with business dealings on the board. You know, for example, you can have your banker, your lawyer, and your accountant on the board, and they can be considered, you know, community members for purposes of this test. Okay, let's go to the next key area, and that is intermediate sanctions. And intermediate sanctions were kind of Congress's way to say that, all right, there's certain instances where you're going to have private inurement. There'll be people who will be benefiting improperly from the organization. And it may not be the case in every situation that the organization should lose its exempt status. Maybe there should just be a system where we impose some penalty taxes on the insiders and we'll let you keep your exemption. And that's what it is. It's a system of penalty taxes on insiders, referred to here as disqualified persons, who improperly benefit from the tax-exempt organization. Now, how do you improperly benefit? You enter into what's known as an excess benefit transaction, which means that the amount that the organization gets in value is less than it's paying the person providing that value, whether it's compensation or a transaction. It really looks at transactions, you know, compensation, services, things like that. Now, who is this focused on? It's focused on disqualified persons who, if you look at the definition, it's kind of loose. It's generally anyone who can exercise substantial influence over the organization. Certain people are per se disqualified, like your officers, your directors, your key employees, but there's facts and circumstances where other people could be. You know, for example, perhaps the founder or a substantial donor in certain circumstances might be a disqualified person. Okay. Now, one of the keys to understanding intermediate sanctions is what's known as the rebuttable presumption of reasonableness. And it's a process that organizations can go through to create a rebuttable presumption that whatever they do, whatever transaction they approve, is reasonable. And if it's reasonable, then there will not be any intermediate sanctions. And these presumptions are not only important for the insider, but they can also be important for the people serving on the board. Because if you're on the board and you knowingly enter into one of these transactions, you can also be subject to a penalty. And the standard for knowingly is relatively loose. I mean, it has some language in there that says, well, you should have known that this was an improper transaction. So a lot of organizations try to go through this process, and especially in the area of compensation. You know, and if you don't go through this process, here's an example. You don't go through the process, you go out and you get a compensation study done, you get an appraisal done for a transaction, and it shows up with a number. And what happens with that number? Is that number safe? Well, possibly. If you don't go through this process, you have your number. Let's say you have a property transaction, for example. It's an appraisal. You have your number. The IRS comes in. They'll have their number. And you go through a court. You know, if you end up going to court, a court could split the baby, so to speak. And that's what they've done in some of these transactions. But if you're a penny over your number, the tax applies. So you lose. So it's sort of like that number has to be the number if you don't go through this process. Now, what is the process? It's really a three-step process. First, the transaction is approved by a board or delegate, and in order for it to be a delegate, it has to be a committee that has authority under state law to approve that transaction. So usually that's going to be a committee comprised of directors that is composed of entirely independent, unrelated individuals not controlled by the disqualified person. The amount is paid is based on appropriate data as to comparability of value. So paper the file, that's what that means. Go out, gather data, get your studies done, give it to this committee. Interestingly, let me go back to the first point. And this kind of can differ from a lot of conflict of interest policies that organizations will have. If you have someone on your board who's doing this transaction, or someone on the committee who you're looking at, they can recuse themselves from the meeting, and you can still have that committee satisfy the requirements. However, that person can only be there to answer questions by the committee. They can't really do a formal presentation as to why it's good. They can get called in by the committee, answer questions, then they have to leave during all debate and voting. So it's oftentimes more strict than your conflict of interest policy will have. And the last is you have to maintain adequate documentation in the file, and there's a number of rules on that. Now, interestingly, as part of the new 990, this is a question they ask. Do you go through this process before you approve one of these transactions? So you're basically telling the IRS whether or not you do it, and if you don't, that potentially could lead to more scrutiny. Okay, let's take a look at who is an independent member under the Intermediate Sanctions Safe Harbor. And for this purpose, it's a little bit different than the other independent purposes. It really doesn't focus on whether the individual is independent in relation to the organization. It focuses on whether the person is independent of the insider. In other words, I can still perhaps get some compensation or have transactions, not be fully independent. As long as I'm independent from this insider, I can probably serve on this committee. So let's take a look at who is independent. Well, obviously not the disqualified person, nor their immediate family members. And by family members, you kind of go up and down. You don't go cousins, things like that. So, but parents and children can be. You're not in an employment relationship where you're subject to the direction or control. So if you're looking at the CEO's compensation, obviously anyone underneath that person can't be on the committee. Is not receiving compensation or other payments subject to approval by any disqualified person participating or economically benefiting from the compensation arrangement or transaction. Now, I think that relates primarily to independent contractors and things like that, and there is overlap between some of these where you could possibly fall into multiple categories. Has no material financial interest affected by the compensation or transaction. I think that would be an example if you had a banker who was financing the transaction, if you had maybe a broker who expects a commission from the transaction. Obviously those persons couldn't serve on the committee. Now the last one is the one I always struggle with, and I also think that can be the one that will be the toughest and a lot of times to satisfy. And this person does not approve a transaction providing economic benefits that any disqualified person participating in the compensation arrangement transaction, who in turn has approved or will approve a transaction providing economic benefits to the member. Now I think this is sort of like, well, I'll approve your transaction if you approve mine. That's sort of what they're saying. Now let's go back to, for example, a lawyer. Let's say you have a lawyer on the board of a large law firm that provides services to the organization. This is not too uncommon. Well, can that person sit on the compensation committee, for example? And the answer is probably not. If it's the CEO who reviews the legal bills, the answer is probably not. Now, Tracy will get into some of the 990 questions, but in some situations, that lawyer might be considered independent, depending on how you read the instructions. If it's a large enough law firm, their percentage interest might not matter, but I think you have to be more careful when you're looking at the intermediate sanctions. Okay. The last area is the IRS 990 reporting requirements. And these came about in 2007 as part of a total rewrite of 990. The IRS really expanded what you're required to report on. And one of the areas of focus for them was governance. So now on the new 990, you actually have to report the number of independent directors that you'll have. And the IRS says that they'll use that to help them determine what companies or what organizations they may audit. I don't know if that's the case or not. But one thing is clear is that donors or other folks can easily look that up and see how you report it. And generally, most organizations that I've dealt with, a lot of them are trying to move towards being able to answer that question affirmatively. Our next speaker is Tracy, and she's going to go into how you do that. Did you have any comments on anything I mentioned before we move on?
The only thing I was going to add is when we get into the next segment, which has to do with answering the questions on the 990, I would just point out and reemphasize what Lucian had said, which is if you look at the fifth category for intermediate sanctions, it really doesn't have a dollar limit. It doesn't have a de minimis dollar limit that says, well, if your transaction is a certain level. It says basically, to my way of thinking, if you've got a comp committee situation and you're looking at the CEO's comp, and there's any type of approval the CEO has over a contract you have with the organization, you're technically not meeting the standards for rebuttable presumption, which I think is important to know. Would you agree with that?
Yeah.
So I'm picking up with page 16 of our slide presentation. As Lucian said, we have the new 990 that was came out just several years ago, and which asks a lot of questions and provides first a question about whether the voting members of the governing board, how many there are. You can see the question is 1A, and then B is how many of those voting members are independent. The second thing that's done, and again, it's in the directions to the 990. It's not case law. It is not statutory. It's in the directions. There's a definition of what is an independent director so that you can answer questions 1A and B. And the definition, as it appears in the instructions, is that a three-part test. The director may not be compensated as an officer or other employee of the TEO or a related TEO. Now there is an exemption for religious personnel, but other than that, it's pretty clear if you're an officer or employee compensated by the organization, you're not independent. So all the people that sit on the board of directors who are employees of the institution or officers would not be considered independent. And if they're voting, they need to be counted. Take questions at the end if we could. Okay. The second bullet is that the director may not receive total compensation or payments exceeding $10,000 on an independent contractor basis. So expense reimbursement for directors is okay, and there's even some de minimis director compensation that can be paid, but if you're an independent contractor and your bill to the TEO is in excess of $10,000, you're not independent under this standard. And lastly, and this is the one that's most important, or most difficult, I guess, to discern, neither the director nor any family member of the director may be involved in a transaction with the TEO, and that should say whether directly or indirectly, or through an affiliation with another organization that's required to be reported on Schedule L. So the key point here is you've got a transaction that's reported on Schedule L, and you've got a director involved in one of those transactions. That person is not independent. One little small point I would make is that this is really interesting in light for health systems in light of the fact that it doesn't really deal with the voluntary medical staff of a hospital. In the past, anybody who was a physician, as Lucian said, is considered an insider. Theoretically, health systems could have a physician on the board of directors who's part of the voluntary medical